Nobody could have predicted that this high inflation would have contributed to an economic slowdown. At least that's what the Federal Reserve Bank says, that's what the government says, and that's what everybody in between said. And now with the threats of a recession becoming more and more apparent, if we're not already in a recession, what you have to understand is that 10 years from now, people are going to look back at this time, these few years where we're going to go through a lot of economic craziness, and some people are going to become incredibly wealthy because of this economic slowdown, and other people are going to lose everything. I want you to be a minority mindset thinker, meaning somebody who thinks differently than the majority of people. That way you can use this coming slowdown as an opportunity to become wealthy by understanding what's going on and by knowing what to do. And if you watch this video until the end, you're going to know exactly how to do that, because I'm going to be going over specific things that you can be looking for, specific things that you can be thinking about buying. So if you or somebody you know is wondering what to do to become wealthy, to get rich when you have a market slowdown or a recession, watch this video. This video is going to cover the entire thing, so make sure you watch this video in its entirety. Let's start with this. If Macy's buys too much stuff and now they have too much inventory, or if a store is on the verge of going bankrupt, these stores might have a liquidation sale where now they're going to sell their stuff at a discounted price, and you're going to see commercials and advertisements for these new discounts that they have for purses and sweaters and all that stuff. When that happens, you see a line around the block of people trying to snag a purse or a sweater at a discounted price because everybody wants to get the sale. Well, when you're buying this stuff from Macy's or whatever store, you are buying a liability. You are making money for Macy's or the store, but you're just buying something for you. What happens here when you have a recession or a market slowdown is the asset, the business, or the thing that makes money goes on sale. And this creates an opportunity for you now, the investor, to buy a piece of the production, the business, the real estate, the investment at a discounted price. And this is where you need to know what to look for and how to find the opportunity. The nice thing about shopping for assets on discount as opposed to shopping for liabilities on discount is when you go to Macy's when everything's on sale, you have everybody there trying to buy the same stuff. You might have to fight somebody to get that sweater or to get a TV. But when we're talking about buying assets, there's no lines. You're not competing against everybody, and now you have so much opportunity around you if you know where to look. So the question then becomes, where do you look? And the answer to that is going to depend on how involved you want to be. And in this video, I'm going to start by going over the least involvement on your end, going into the most involvement. So I'm going to talk about a number of different strategies depending on how risky you want to be, depending on how involved you want to be, depending on how much time you want to invest, and depending on how much money you want to invest. Booms and busts are a part of our economic system. They've been happening for centuries and they will continue to happen. And what happens to so many people is they don't expect it, and so they get blindsided by it, and then they lose everything. But the people who understand it, the people who are financially educated, are not shocked by it. They just know what to do when it happens. So what happens typically is you see these types of booms and busts. Overall, the market is growing, but you have these boom periods, and then you have these bust periods. So this is when you have a market crash, you have a recession, you have bad things happening, people get scared, they panic, they sell off, and this creates a huge opportunity for you to now come in, buy, and ride the wave upward. Now the goal for you isn't to perfectly time the market, because nobody can perfectly time the market. Nobody knows what's going to happen tomorrow. Nobody knows when a pandemic is going to shut down the economy. You can't predict these things, but when you see these types of drops happen, it creates opportunities for you to come in and buy when they happen if you're financially educated and if you're prepared. When I say prepared, that means now you have access to cash, you have access to capital to go out and actually make an investment. Now, what does that mean? That means now you have to start putting aside cash. You need to start earning more money. That way you have a margin, you have money, you have capital to actually go out and take advantage of opportunities that come your way. Financially educated means knowing where to look, knowing what type of opportunities you want, and how involved that you want to be. Now, I'm not going to go over all the different factors that are leading to the economic slowdown that we're facing today in this video. I have other videos on my channel where I've already gone over that. If you want to watch that, I will link something for you down in the description. But in this video, let's start by talking about the least involved way for you to take advantage of this coming economic slowdown. This is for some people now who don't want to spend a ton of time or energy or effort or even risk trying to figure out how to invest their money. Number one, the most passive way for you to take advantage of an economic slowdown and a market crash is by doing something called DCA, which stands for dollar cost averaging. What this is now you have a system set up where every single week, ideally, or every other week, every time you get paid, now your money is going to automatically leave your checking account and it's going to be automatically, passively, consistently invested into a number of different stocks or ETFs or potentially even cryptocurrencies, depending on what it is that you want to invest in. I'll talk about the different opportunities you have, but it's going to automatically be invested. Now, the nice thing here when you have an economic slowdown isn't just that you potentially could have more dollars to invest. It's that when you invest a dollar, that dollar is going to stretch even further. To give you an example, if you wanted to buy a stock that's worth $100 and every single month you're investing $100 into this company, well, that means every month you're getting one share. But if you can keep investing this $100 a month, and let's just say the price of the stock drops to $50, well, now you invest $100 and you're getting 2 shares for the same price as before. I have a dollar cost average system set up, but I don't dollar cost average into individual stocks. Instead, I dollar cost average into ETFs, which are funds that give me exposure to a whole lot of stocks. Because now when I do this dollar cost average system, I'm not in dollar cost averaging for 6 months, for 6 years. I'm dollar cost averaging forever. And so I don't want to have to worry or research the companies. I don't want to have to think about what companies I'm investing in. Instead, I invest into a fund that gives me exposure into a lot of different companies. That way I can keep dollar cost averaging essentially forever. That way I don't have to worry about it. I don't have to think about it. It just happens consistently, passively, and automatically, because this is my most passive, my least thought about investment. And this will continue to happen whether the market is up or whether the market is down. This is a long-term investing strategy that you don't want to have to be thinking about what you're doing. You just set it up and let it happen forever. One example of this, now I can't tell you what to invest in because everybody's financial goals are different, your risk tolerance is different, your time horizon is different. Just giving you some examples to research. One example would be investing into an S&P 500 ETF. The S&P 500 is a group of the 500 biggest companies on the stock market. So it's essentially a way for you to invest in the American economy. 2 ETFs that give you exposure to this are VOO and SPY. I personally have some of my own money invested into VOO as a disclaimer, but these 2 ETFs do essentially the same thing, where now you're getting exposure to these 500 companies. If you want to take on more risk, then you can consider investing your money into ETFs to give you exposure to technology and innovation. This could be ETFs like QQQ and ARKK. I do have money into the ARK funds, but QQQ now gives you exposure to things like the NASDAQ, which is primarily composed of tech companies. ARKK is another ETF that invests in now innovative companies, tech companies. These types of companies are going to get hit especially hard because there's been a lot of cheap and free money floating around for the last decade, and they've already been hit very hard. But the companies that survive could also have the opportunity to thrive after, so it can create opportunity. Is it more risky? Yes, absolutely. Because many of these companies rely on cheap money. They rely on cheap capital. They rely on investment dollars in order to grow quickly. And our economy and our economic market is changing, which could negatively impact these types of companies, but more potential risk, more potential upside. And this is where you got to understand where it is that you want to be investing and how risky you want to be. What if you're looking for some passive income, some cash flow where you can get paid without having to sell your investment? Then you can look at investing your money into dividend-paying ETFs or high dividend-paying ETFs. A couple examples of this would be VYM and SCHD. I have my own money invested into these funds as a disclaimer. But now what you're doing by investing in these ETFs is you're investing your money into companies that are working to pay dividends. And this is where you got to understand what your goal is, because now when a company is paying out a dividend, that means they're taking their profits and instead of reinvesting the money back into the company, instead of reinvesting this money into their savings, they're taking this cash and giving it away to shareholders. And so you're not going to see as much growth here that's potentially here because most of these tech companies are not focused on paying out dividends. They're focused on reinvesting all their profits and some with the help of debt, with the help of other investment dollars. That way these companies can grow as quick as possible, as fast as possible, the highest risk, versus these companies are just working for that slow and steady growth. And then when you go through an economic slowdown and companies see the profits get cut and people then start cutting their dividends, that also hurts these companies, especially because now when the investors are investing in these high dividend paying companies for their dividend and then their dividend gets cut, now many investors are more likely to sell the stock because they're not getting that cash flow. But that can also create more opportunity here if you're investing your money into these dividend funds, because then once the economy recovers and these companies start recovering their profits, then they might and hopefully will start repaying their dividends, which would then make it a more attractive investment for investors again. So not only do you get to buy in when dividends are cheap, but hopefully you'll also see the price of your investment rise. Now, does it always work out like this? No, but this is where you're hoping and investing your money into the places where you can see the most potential upside based off of what your goals are. And then you could also consider dollar cost averaging investing your money into emerging market ETFs. These are now companies that are outside of the United States that don't operate based off of the dollar. So now when you're worried about a recession, you're worried about an economic slowdown, you're worried about inflation hurting the dollar, well, one thing that you could potentially do is invest your money outside of the United States into countries and companies that are less affected by what's happening within the United States. A couple ETFs that can give you exposure to this are VWO and SCHE. I have my own money invested into these funds as well, but now again, higher risk, but more potential return, because I'm investing in companies and countries that are not heavy in the United States exposure. These are companies that are growing in other countries like Brazil and China and Taiwan and Japan and Korea. And so now when you're investing in this, you're trying to get exposure elsewhere, but it has more risk because many times these countries and economies aren't as stable as the United States. They're operating with a currency that isn't as stable as the dollar, but more potential upside. And so now this is where you got to understand where it is that you want to be investing, what kind of exposure that you want, and how much money can you now invest every single week. This is a way for you to build wealth, not just through a recession, but over your lifetime. However, when you have market slowdowns, when you're dollar cost averaging, the dollars that you're investing through your dollar cost averaging can buy you more shares, can buy you bigger quantities of things because the prices of things are going down, and every dollar that you can invest will stretch further because you're seeing this essentially deflation in the asset markets, in the stock market. So it gives you the opportunity to buy more for each dollar that you invest. And so when you go through these types of market slowdowns, you want to be dollar cost averaging even more aggressively. And the nice thing is you don't have to worry about trying to time the market here, because now when you have a dollar cost average system set up, where now you're buying, say, every week, well, now you just keep buying whether the market's going up or down, and you're going to see these wild swings upwards and downwards and upwards and downwards, and you don't have to worry about it. Because every time it comes to your day, for me it's every Wednesday, it does not matter what day you pick. Whenever your investment day comes, you'll be able to purchase more shares of your investments. Now at the time of me recording this video, I use a platform called M1 Finance. They are an affiliate of Minority Mindset. If you want to learn more about how to use them, I got the link for them down in the description. There are many different brokerages that allow you to do this type of dollar cost averaging. Do your own research. I like M1 just because it's super simple to use, but you can do your own research. Now, before I go on to the second out of the 4 different ways that you can build wealth through an economic slowdown, I want to talk about the 2 other things that I dollar cost average, because I also dollar cost average physical gold and cryptocurrency. Now, I dollar cost average physical gold because I look at gold as hard money. Gold is a better store of value than currency, our paper dollars, because you can print our paper dollars on command. It costs 12 cents to print a $100 bill versus our physical gold takes time, effort, and labor to mine physical gold. So it's an alternative way to save money. It's like my insurance against everything going wrong. If the dollar completely collapses, if we have a currency crisis, that's where gold comes in handy. So it is kind of like a doomsday protection investment. Now, you don't need a ton of money to invest in physical gold. I do a passive type of investing where I invest in physical gold once a month. I use a platform called Vaulted. They're also an affiliate of ours. I have their link in the description if you want to see how to do that. But this is where you got to understand that my investment in gold isn't there to make me rich. Like, I don't invest in gold the way I invest in my ETFs, where I'm looking for growth, or I'm looking for cash flow. Gold is more of just protection. It's an alternative to saving, and it's that worst case scenario, inflation, doomsday type of protection. So that's my gold investment. Cryptocurrency is a kind of hybrid where I invest in cryptocurrency because I believe in the technology, I believe in the future of cryptocurrency, but I also think it's very risky, so it's a small piece of my portfolio. And this is where you got to understand, don't invest into things just because people are doing it. Invest into things that you believe in, that you want to get exposure to, that you want to hold on to, where you're actually holding on to the asset that you want to own. So I dollar cost average crypto. I buy things like Bitcoin and Ethereum and a couple other coins. I dollar cost average every day. So for me, when I see these huge swings, it doesn't really matter to me because when prices go down, I just buy more through my dollar cost average system. So it's completely passive, it's automatic, and it happens daily for me. And this is where, again, you got to figure out what type of things you want to invest in, what things do you believe in, what things do you want to get exposure to, and then how do you invest in it. This is the most passive way to do it. And if you don't want to be thinking about what you're doing, you just want to get exposure and you want it to happen consistently, well, now you can set up a dollar cost average system and you never have to worry about it, which then brings me now to the second way that you can invest your money, which is a little bit more involved, but it can give you even bigger returns. This is what I call drip investing. And this is an active way for you to invest in liquid investments. Liquid investments are things that you can buy and sell quickly, kind of like stocks or cryptocurrency. And an active investment means that now you're looking for a good company, an individual thing that you want to buy, and you're waiting for a good price. But the reason why I call it drip investing is because, again, you can't perfectly predict when the price is that you want to buy. Instead, you buy in phases. So previously, when we talked about the dollar cost averaging, I was talking about investing in ETFs. Now I'm talking about investing in individual companies. This comes with more risk, but it also comes with more potential upside. And it also comes with more work. Now, for the majority of people, I would say for 80 to 90% of people, dollar cost averaging is the best way to go because it requires the least time, the least research, and the least psychological investment, because investing is just as much financial education as it is investment psychology. Because if you can't manage your emotions, if you can't manage your investments from a psychological perspective, it is going to be very difficult for you to actually make any sort of money, because when you see swings in the market up and down, you don't want to get greedy, you don't want to get emotional, you don't want to panic. And this takes a lot of skill because it sounds simple. Oh yeah, big deal. But when you actually see your $10,000 investment lose 80%, well, that's where you need to make sure you have the right psychology to protect your investment and know what you're doing. So an example of the way that this works, let's say that you want to invest in the Amazon company. You have done your research on Amazon, you like the investment, you like the company. Now what you're waiting for is a good buying point. And this is where now you're going to run the numbers. You're going to look at the financials. You're going to go to places like Seeking Alpha or Yahoo Finance, and you're going to start studying the numbers. And you're going to see, okay, this is the revenues, these are the profits, this is what the investment needs to be for me. This is the price that I need to see. When the Amazon stock falls by 15%, that's when I'm going to make my first purchase, because now that is a good price for me. It feels like it's undervalued. But when you see the stock fall by 15%, that's when you would come in and buy, but not invest all of your money into it. Let's say you have $1,000 to invest. When you see the price point that you like, you see the Amazon stock fall by 15%, then maybe you invest $200. And then if the stock falls by another 10 to 15%, that's when you'd come in and invest, say, another $225. If the stock falls by another 10 to 15%, then maybe you invest another $250. That way now you're investing in phases on the way down, because now as the stock falls, you invest more. You get to invest more aggressively on the way down, and you don't have to worry about perfectly trying to time the market. You're buying it in phases. That's why I call it drip investing, and this is a more active way. So if you want to invest in individual companies, now instead of trying to perfectly pick the perfect price to come in and buy, this is a strategy where now you can come in and buy in phases on the way down, because nobody knows how long this recession is going to last, how long this market crash is going to last, how deep it will be. It's impossible to predict that, but you also don't want to miss out on great buying points, because the people that try to perfectly pick this bottom are the ones that end up missing it, because you see the stock fall to here and you're like, ooh, maybe I should come in and buy it. Actually, I'm just going to wait for it to fall another 10%, and then it falls another 10%. And then you say, you know what? I think it's still going down. I'm going to wait for it to fall another 10%. And then it goes down 2 more %, but then it starts to go up. Maybe the Federal Reserve Bank starts doing some sort of quantitative easing. Maybe you see some sort of government regulation change. Now the markets start to go up, and now you say, I'm going to wait for it to fall a little bit more. Now it's too high. And it falls a little bit, and you're like, you know what? I'm going to let it go down a little bit more. That way I can get the best point possible. And then, boom, markets start to rise. And you're like, this is way overpriced. This is way too expensive. I don't want to buy it. And then you continue to see it rise. And now you miss the opportunity to buy. We see this happen across time. In 2020, when the stock market was collapsing, this is what so many people were trying to do. They were trying to time the market. How do I know this? Because I was making videos about this. And I talked a lot about this drip style investing because it was something that I was doing, and I talked very openly about it, how I am buying now. If I see another 10 to 15% drop, I will invest even more aggressively. If I see another 10 to 15% drop, I will invest even more aggressively. And the comments were flooding in of people saying, why would you buy now? Wait for the market to fall more. That's when you should start buying. You're buying way too high. And I bought in phases on the way down. And then the people that kept saying, don't buy now, don't buy now, don't buy now, missed the opportunity, because then the Federal Reserve Bank opened up the money printer and the market started to rally. And this is where you don't want to miss that, because yeah, we might not see the Fed do the same thing. Maybe we will. We can't predict what the Federal Reserve Bank does, but you don't want to miss the great buying points, because when you're so focused on the perfect buying point, when now you get suckered into missing the good opportunities, because 10 years from now, are you going to be so worried about a 10 or 5 or 8% difference in the purchase price if you can see a 200% growth in your investment? And this is where you got to have the long-term investment thinking and know what it is that you're investing in. This is where you want to be doing that financial education in advance of knowing what it is that you want to own. Make a Google sheet or an Excel sheet, or take a piece of paper and write down which investments you want to own and what is a good price for you to start buying. And then just stick to your investment strategy, because now you're investing for the long term. And if you see the price of your investment continue to fall, buy more aggressively as it goes down. And yes, the same strategy also applies to cryptocurrency. It's not just stocks, it's any sort of liquid investment. So if you really believe in cryptocurrency and you see a price of a good crypto that you like fall by a lot, then you can use this as an opportunity to invest. Just understand that cryptocurrency is even riskier than investing your money into stocks. Stocks have proven itself the test of time, versus cryptocurrency has not. And so yes, you can see more upside in crypto, but also more risk. So you want to understand that going in. And when it comes to this type of active investing, this is where you also want to be aware of what's happening in the markets around you. That way you can make smarter decisions by being well educated as an investor. That's one of the reasons why I created market briefs as a completely free resource to help you stay up to date on what's happening in the financial markets. Market Briefs is a free financial newsletter where every day my team is breaking down what's happening in the stock market, the real estate market, the crypto market, inflation, and the global economy. It's a fun read, it's easy to read, it's witty, and you can read it in less than 5 minutes every morning. So if you're an investor, you need to join something like Market Briefs. That way you can stay up to date on what's happening in the markets. And Market Briefs is completely free. So if you want to join, I got the link for you down in the description below. Third, if you want to be even more involved, well, then you can think about investing your money into real estate. Now, the reason why I love real estate investing is because real estate gives you something tangible, something that you can see, feel, and touch, especially when you're going through these types of volatile recessions and market crashes, when you have this type of high inflation, when you're worried about the currency, when you're worried about the global economy. Paper assets can see huge upswings and downswings very quickly. Versus real estate, even though you might see real estate prices go up or down, the thing with real estate is you own something tangible. Like you own the bricks, you own the land, you own the windows, you own something that people need, that you can see. People will have to pay you rent to live there. And so even if the currency were to fail and people don't have dollars or whatever, I mean, we're talking about worst case scenario, well, you could charge people chickens for rent. You could charge people milk for rent. You could charge people cryptocurrency for rent. And so this is where you have more control, but of course it takes more work, because now if you want to invest in real estate, you're going to go out and buy a property. And in this case, we'll talk about a home. And in this home, you're not buying this home to live in yourself. You're buying this home for somebody else to come in, and they're going to live in this great property that you have given them. In exchange for them to live in your property, they're going to pay you rent. Now, the nice thing is, if you do it correctly, this rent will cover your property taxes, it'll cover your mortgage, it'll cover your insurance, it'll cover your maintenance fees, and it'll put some money in your pocket every single month. The problem is over the last number of years, we've seen real estate prices skyrocket. Rents have gone up, but real estate prices have gone up so high, along with mortgage rates, making it very not profitable to buy a lot of real estate, which means that real estate returns, ROI, have fallen significantly, making it not very attractive for people to go out and invest in real estate. Like when I was buying real estate a few years ago, it was very simple, very easy, I should say, to find a 7% cash on cash return on my money. Meaning for every dollar that I invest, I get 7 cents of cash flow profit at the end of the year. So if I invested $100,000 into a property, I would make $7,000 or more of profit at the end of every year just from the cash flow. So this property would pay me $7,000 of profit a year. Now it's become much harder to find these types of 7% returns, because property prices have gone up so high, but rents haven't gone up high enough to meet these higher returns. Now you might be saying, but rents are already so high. You're right. But what I'm saying is that property prices have gone up so high, making it less attractive for people to become real estate investors. And now, as we're facing the cycle where interest rates have gone up so much, where home prices have gone up so much, people are walking away from homes. And this will eventually start to hurt real estate prices, which means it could create more opportunity for real estate investors. And this is where now you have to be a smart and astute investor and understand what your goals are. Because you have some people that invest in real estate for this type of cash flow. That's what type of investor I am. When I invest in real estate, I'm looking for one thing, cash flow. I need to make sure that this property is going to pay me the cash flow that I need, the cash flow that I'm expecting every single month, essentially forever. That's why I'm investing in this real estate. You have other people that invest in real estate that don't really care about this cash flow. In fact, they will take a 0% cash on cash return on their money, maybe even a negative return on their money, meaning every year they're putting their own cash into the property because they're hoping that they'll be able to sell the property for a 40% growth rate because property prices are going up so quickly. That's not for me. That's not my game. Some people have made a ton of money doing that by holding onto properties for a few years and selling them for big prices in growth markets, but that's not what I'm interested in. I look for properties like homes or apartment complexes that pay good cash on cash returns that will allow me to build a stream of cash flow. That way now it is a passive, consistent stream of cash flow that I don't have to worry about. But this is where I want to have enough margin here. That way, if property prices fall and if rental prices fall, I don't have to worry about just not being able to pay my expenses because I still have the margin to cut my rent and still make a profit. And this is where you want to make sure you understand what type of area that you're investing in, because some areas are going to be impossible right now to find a 7% cash on cash return on your money. Other areas, you'll still find 7 to 15% returns on your money, but it's going to be much riskier. There's going to be more of a beat down, rundown area. And this is where you got to understand what type of properties you want to be investing in. But this is where now looking at the right properties in the right neighborhoods is what you want to be doing. You want to understand what type of investments you want, what type of returns that you want, and now looking at the areas, and when you see prices drop and you see properties with the cash flow that are now in your range because property prices are falling, that's when you want to come in and pull the trigger to go out and buy. But this is where building the right team early helps. And when I say right team, I mean having things like a good property manager. Start interviewing property managers around you. You don't want to be the person managing your own real estate, dealing with tenants, dealing with paying the bills, dealing with all the other maintenance issues. Have a team to manage that. That way you can focus your time and energy on the investment side, not the management side. So start interviewing managers. See how they operate. See how they work. See what their fees are. Just because one is more expensive than the other doesn't mean it's bad. It means that they might or should at least offer more services. So understand what type of services they offer. See if they charge a fee to take care of the maintenance oversight. They're going to charge you to do the maintenance. Someone's going to have to do that. But are they going to charge you to manage the contractor, or is that included in the fee? See how they evict tenants. What are their requirements to evict tenants? What are their requirements to pick a tenant? How picky are they when it comes to the actual tenant selection process? What are their fees when it comes to actually picking a tenant? Are they going to charge you a month's rent? Are they going to charge you a $300 flat fee? Because there's many different options here. And what rate are they going to charge you if you bring them a portfolio of real estate? Start asking these questions. Also look for real estate contractors. If you have a good team of contractors, then you can come in and buy distressed real estate, which is one of my favorite types of real estate to buy, which is physically beat up real estate. You have people that were living in a home, didn't care for it. Maybe they went underwater in their home, they got foreclosed on, something happened, and now they want to leave. And now they beat up the property's in horrible shape, and nobody wants to buy it, which means you have no competition. And now you can come in and buy this property at an even bigger discount. And that discount is going to be more than enough, hopefully, to cover the new renovations and upgrades. Now you'll have a fully renovated, fully upgraded property at a below market price. That can create more upside and more percentage returns for you, but you need a good contractor and good contractor team to do that. You need a good real estate attorney, a good attorney who specializes in real estate that's going to help you go through the deals. Even if it's a small deal, have an attorney review your contracts, because if you don't, there are so many headaches that can happen. If you don't have a good attorney, have a good real estate accountant. That way you can make sure you take care of your taxes, and make sure you have a good real estate agent who's going to be bringing you the deals to make it easier for you. I am a licensed real estate agent myself. I'm also an attorney, but I don't do my own paperwork. I have an attorney that manages my legal side of the real estate stuff, and I have a real estate agent that not only helps me bring me the deals, but also fills out and completes all the paperwork. That way I can spend my time focusing on finding the real estate. And this is where establishing a good team, knowing what it is you're looking for, and if you want to be involved in real estate, knowing that okay, when prices drop, that's the best opportunity for you to come in and buy the real estate. The fourth option, which is also the most intensive, the most active, and the highest risk, but also has the highest returns, will be for you to go out and actually buy a physical business that is now on sale. And when I say a business on sale, I don't mean going to Macy's and buying the stuff that's on sale. I mean buying the Macy's. Now, of course, there's smaller versions of this where you don't have to have billions of dollars. Some of them are going to be in the millions of dollars. Some of them are going to be in the hundreds of thousands of dollars. But if it's under a few $100,000, it's probably going to be not a very established business at all, but this is where understanding the different opportunities that are there. This is going to be more capital intensive. It doesn't all have to be your money. You can use debt, you can use investors' capital. But now going out and trying to find the opportunities to buy a business and take it over and renovate it and potentially then flip it or continue to operate it. Now, I have never taken over a business like this before. I have invested in businesses as a minority smaller partner, but this is where you're going to have a whole different range of opportunities where you can be a silent partner and invest as little as, say, $100 to a company and get a small little piece of it, or bigger options where if you have the capital to actually buy the entire business and then take over the company and then, restructure it and rebuild the company. The whole idea here is when the economy goes down, you can have some businesses that are overloaded on debt, that are over structured in a way where they're not able to make money. And this can create opportunity for you to come in because now the owners of the business might want to just get out or might not have the ability or interest to actually fix the business. Now, if we're talking about the smaller scale where you're investing in a minority stake of a company, there are platforms that allow you to do this, something like WeFunder or Republic or Start Engine. These allow you to invest in startups. And as you go through an economic slowdown, chances are you're going to see more companies, more startups that will need more cash in order to stay in business. And they might turn to things like crowdfunding sites, like I just talked about, to raise more money from regular people. And they will more likely offer a discounted valuation. That way they can attract more investment dollars. That way they can stay in business. So that will allow you to invest in companies with as little as, say, $100, sometimes a couple $100. But then the bigger you go, the more capital you'll need and the more intensive that it will be if you're going to be actually involved in buying the company. There's a number of different sites out there that show companies for sale. And as you go through economic slowdowns, as companies can't keep paying their debts, as companies can't keep paying their bills, they're going to become more desperate to sell, which means that they will be more likely to sell the company to you at a discounted price. And if you find something where you have experience that you're interested in, this can create an opportunity for you to then go out and buy a piece or the entire company at a discounted price. If that is something that you're interested in, then I would recommend you getting a good accountant and a good attorney on your side. That way they can help you through the due diligence period, that we understand the numbers and the legal side of the company, that we know what you can do and what you can't do.
Inflation needs to come down, right? I think we can all agree to that. The Federal Reserve Bank says that they want inflation to come down. They want inflation to come down to 2%. Well, how do you do that? You need the price of things to stop going up or go down. And so one of the things that they say is they want to cool the housing market. So what does that mean? Well, the housing market makes up a chunk of the CPI,